So let's continue to talk about earnings management and fraud. So earnings management, you could think of as, there's some earnings management, so basically, let me go back. So earnings management is managers' accounting choices that are designed to achieve something other than to maximize transparency. All right? Now, there is the most pedestrian earnings management, because managers do have a lot of latitude in making accounting choices that are perfectly legitimate, and within that realm, within that space, they can make decisions that don't violate any rules or anything. We might say, if we see a lot of sort of accounting choices that have a tendency to make the company look like it's doing better than it is, but they're still within the realm of accounting choices that are legitimate, we would say, well, maybe the earnings quality isn't so good there. A lot of times we use earnings quality to talk about earnings management issues while it's still within the realm of management decision making. And then you can get into sort of abusive earnings management, where the gray areas. So if we diagram this, you could say, well, managers have this region in here where they can make choices. So if this is sort of true earnings here, so there's true earnings. They can manage earnings. This is on the plus side and the minus side. They can manage earnings this way or this way. You might say, why would they manage earnings down? Well, we'll talk about that. They do. All right? And then you get into, I don't actually have a gray color, so I'll use black. All right? So then, but they could get into these regions out here, where, and usually we're dealing here with this, right? In this case, where the earnings management they're doing is really highly suspect. For example, using revenue recognition methods that technically look like they comply with basic rules, but it's just not believable. For example, an example where you have something that, so when we have revenue, we have to be pretty sure that we're going to be able to collect on the receivable, for example, related to the revenue. Maybe you have some kind of a long-term contract or something, or deferred payment requirements, and you really don't know or don't believe that you're ever going to be able to collect that, but nonetheless you show the revenue, you say, oh, I'm sure we're going to be able to collect that. There's no question about that. So that's really getting into this highly abusive region. And then, of course, you can get beyond those as well. It's my red one. I don't know. Oh, it's right. It's here. So up here, you could, I guess, down here as well, but that you just don't see. But up here, you can just engage in out-and-out fraud. So this is, I guess, the discretion region here. This is sort of abusive here. And this is fraud out here. So in other words, you just say, oh yeah, I'm going to add in $10 million of revenues. What's that? Well, there isn't any. I just made it up. I just increase retained earnings by 10 million and increase accounts receivable to 10 million. There's no customer, there's nothing. I just invented it entirely. Completely fictitious. All right, so this is the background we're looking at. And so now the question becomes, so what do managers actually do? How do they do this stuff? What are the methods by which they achieve these earnings management results? So let's think about that. And we can generally categorize those into two basic types. So, first of all, we could have, what should I call it? Well, there's revenue related, and there's expense related. Well, I guess I should say expense, loss, and revenue/gain related. So you probably can see the basic idea here, right? And so when you're involved in earnings management, what you're going to do is the earnings management is going to affect this side or this side in the direction you want earnings to go. Again, some of you may not believe that managers might want to report decreased earnings, but I'll give you an example that shows that that can happen in a minute. But right now, let's just think about the ways that this happens. And again, look through some of those online materials and those links, because they have detailed examples of how companies did this, how they have done it, and I'll refer to that a little bit here. But there's some great examples that you can see and you say, wow, well, that was kind of clever, but abusive, clearly fraudulent. So, for example, if you think about revenue related, so one of the things that we could do would be to somehow accelerate revenue. That would be one thing we could do. In other words, put revenue into the current period that really shouldn't be until a future period. Now, revenue is only supposed to be recorded in a period when basically it's earned and the right of return is minimal. We're sure we're going to be able to collect on it. But you can imagine, for example, that we send a bunch of stuff to our customers and tell them, well, you can send it back if you don't want it. So there's a high likelihood that they're going to send it back. In that case, under accounting rules, we wouldn't be allowed to show that as revenue, but this is something that companies routinely have done. Just ship a bunch of stuff out so they can show revenue for it in the current period. In fact, there's a specific method you can look up called channel stuffing. And so basically you work with your distribution network and you really try to push as much product out into your channels as you can prior to the end of the year. Make sure it gets shipped, right? You have everything written down, everything's recorded just like it was a sale, but you have some special provisions that allow them to return it. So this would happen. Now, of course, now you've got to deal with next term or next year, quarter, whatever it is, right? So it doesn't get rid of all your problems, but at least it gets rid of the problem right now. So that's channel stuffing, a way of accelerating revenues. Another one would be to record fictitious gains. Fictitious, I think that's right. I'm not sure if it's IOUS or OUS. Anyways, so maybe you have some kind of an asset and you have some partner. It may not be an arm's length company or somebody else, and you can come up with some sort of a fake kind of a transaction that allows you to record revenues or gains in the current period. And a perfect example of this is there was this company, Global Crossing, and I think it might have been WorldCom too. But anyway, so what's Global Crossing? Global Crossing was this company that basically developed all these internet bandwidth connections all over the world. And what happened is that it turned out it didn't all get used right away. Now, in fact, they have all these companies nowadays that are called dark fiber. There's all these sort of dark fiber companies that have bought all this stuff and is using it, because now you got Netflix and all this other stuff that is using it. But at the time, it wasn't all being used because you didn't have streaming video and all that stuff. So they had basically overdeveloped it. When the dot-com bust comes along, it becomes clear that it's not going to be used right away. And so the company's trying to figure out, how are we going to be able to show revenue? Things look bad. And so what they did is they would actually trade bandwidth with other companies. And sometimes it was the same bandwidth. So basically, so here's three places, right? So here's my company. Here's Global Crossings here. I hope you guys can see this. I should see if you guys can actually see what the heck I'm looking at. Yeah, you can see that. Yeah. Okay, so there's Global Crossings. Here's company X, okay? And let's see, I need actually two locations here. There we go. And here is location A and B, all right? And suppose I have, this is my link here, A, and this is their link here, to B. And so what they would do is they would actually trade bandwidth. You give us some of your bandwidth that goes to B, I'll give you some of my bandwidth that goes to A, and then they would be able to show this as revenue to themselves. So to the extent that X is basically buying bandwidth capacity that Global Crossings is offering. But it got so crazy that they would even doing stuff like, I should have done this in different colors. So here is, I'll do this in blue. Okay, so this is theirs. But suppose there's also connections between A and B, like this. And so there would be no reason really for them to need to do this, since they all have their own connections. X has the connection to A and Global Crossing has the connection to B, but nonetheless, they would still trade these here and claim that that was revenue. So basically, we'd just be inventing these gains, these revenues that wouldn't exist at all. They were never going to get any cash for it or anything like that. Then you had some additional kind of these barter types of transactions. That's what this is. A barter type of transaction where you're actually trading things rather than paying cash for it. And AOL got in big trouble about this. So let me show you what AOL did. Where did I put my eraser? I don't know. Where did I put that wet thing? There it is. So let me show you how AOL did things. So AOL is running into problems. How did AOL get a lot of their income? Well, so obviously they had, at the time, right? AOL had a lot of subscription revenues from people that had their dial-up connections and accounts with them. That was the big thing. How did they blow that? I don't know. How did they not become Facebook? I don't know. So, I have to make sure I don't get off track in my mind here. So we've got AOL. So AOL is in trouble because the other way that they get revenues is through advertising. You know, all those old banner ads and all that sort of stuff, and you still see them today. But that was a big deal for them. And they were forecasting huge growth. But here comes 2001, 2002, 2000 really. And the dot-com bust, and all of a sudden online advertising, shoo, just falls through the floor. So what are they going to do here? How are they going to maintain their revenue stream? Red is running out. I need a new red. Okay, I'll go to orange. So here's AOL. So they're trying to think, how am I going to do this? So here's what they do. There's actually two processes in this. Here's the first thing that they did is they said, okay, well, here's this company Z. All right? We think company Z is a real interesting company. It's got lots of potential. So here's what we're going to do. We are going to invest. We're going to buy an interest in Z. All right? But the kicker is that Z has got to use the money that we invest, all right, on advertising with AOL. So they have to buy advertising. This is a great, think of your accounting equation entry here, right? What happens? Investment goes up, so you have an investment, right? Maybe it's not such a good thing because it makes more assets you're earning returns over, so that's a bigger asset denominator. That's not so great, but it's not so bad. You know, you've got an investment. It's like gold, right? And then the money, which is of course never in cash, comes back to AOL in the form of this advertising, and so they have revenue. So they have investing and revenue. I mean, it's beautiful. Now, the accounting rules said, well, no, you can't do this. Won't you, this kind of bartering transaction between you can't do that. So then they had to get more sophisticated and change it from that into and use a third company. So what they would do, I mean, you can sort of see how this is working. You have to have three companies involved so that you're investing in one and getting the advertising back from the second one, and you had to develop a relationship between these two as well. But in all cases, these bartering transactions became merely vehicles to create revenues that were never going to be recognized or realized in actual cash received. They were merely there to disguise the performance of the company and make it look like it had revenues that really didn't exist. So there's some examples. Black. Here's some examples on the revenue side, so barter types of transactions. Accelerate, channel something. You know, another one I was going to mention, there's this company, if you want to look up something on the internet to find a good story about this, look up, in quotations, prepaid legal services, revenue, I don't know, deceptive fraud, management, something. You'll find lots of great stories. They're one of these companies that had ways where they had these uncertain contracts they were going to collect on from lots of people, then they recognized revenues on them real soon. All right, now, what about on the expense side? Well, again, we're really dealing mainly here with companies that are trying to increase their net income, although the opposite could be true. So in the case of expenses and losses, what do you want to do? You want to not have expenses and not have losses. Well, for those of you that have had the chance to look at the little video on which is the first thing that's on that earnings management materials I emailed you guys. So you know, for WorldCom, one way to do is to capitalize your expenses. This is an old favorite. Well, think about it. When you pay for something, this is, again, lots of oversimplifications, but when you pay for something, one thing that can happen is that you have an expense. Like if I pay you for the work you already did for me and I'm not going to get any other future value out of that, that's an expense. It's a salaries expense, whatever, commissions expense. On the other hand, maybe I bought a boat or a car or a piece of equipment or some supplies. Well, those are assets. So we say if something has a future, if we pay for something that has a future value, something that we're going to benefit from in the future, tangible or intangible, that's an asset. But if there is no future value, it should be an expense. But there's lots of things that you have to think about. So for example, suppose you have some equipment, right? And you spend some money on that equipment you already have it. It's already in the books as an asset. So you spend some money on that equipment. Should you treat that money that you spent as an increase to the value of the asset, or should you expense it? And so the accounting rules basically say, well, did it somehow improve or increase the value or the life or the usability or the capability of the equipment? Did it make it better in some way, not just maintain what it originally was supposed to be able to do? So if it's sort of routine that was built into the original expectations of what you'd have to do in order to keep it running, expense. But if it actually does improve it, it makes it last longer, it can do more stuff, it's an asset. What a lot of companies like to do is sort of play fast and loose with this and start capitalizing these routine maintenance expenses or expenditures. Expenditure is just the payment for it. The expensing is the actual accounting treatment of showing it as an expense for the income statement, is treat these expenditures as assets. And that's what WorldCom did. They had all this infrastructure. And basically, instead of treating the expenses to maintain the infrastructure as an expense, they recorded it as an asset. So why is that so great? Because now you can depreciate it and show it as an expense over many years rather than right now. So that's a very common way to handle this. Another one is off-balance sheet transactions. And if you want to learn about how this works in technical detail, you can go and look at Enron and look at SPE, Special Purpose Entities. Enron SPE, search for that. But basically what you do is you take your bad assets and any accompanying liability that's associated with it. So imagine you bought some asset, for example, all right? So how do you get an asset? So supposing you didn't pay cash for it. You increase the asset, right, and then you have some liability for it. Well, you have to do asset impairment tests. So if the value of those assets goes down, you're going to have to show the value of the asset goes down. And so to avoid that, what companies will, and then you have a loss. So what companies do is they'll say that, well, let's take those bad assets and the related liabilities and put them off in some other company. Maybe, how do you do that? Well, maybe we'll invest these assets and match the liability to it in these new companies we're developing. And so now we will actually have a new asset that's an investment in these companies with these assets that are really not worth very much. with much larger liabilities, but nonetheless disguising the fact that we really should have asset write-downs, because we have these losses that ought to be recognized, but in order to get rid of them, we moved them off our balance sheet so our auditors don't have to look at those. So that's a good way to disguise those things. The Financial Accounting Standards Board was supposed to do away with them, but instead came up with a thing called the Qualified Special Purpose Entities. Talk about gutless. Anyways, so if we didn't have QSPEs, we couldn't have had the mortgage meltdown crisis in 2008. So you can thank the accounting board members who were involved with that. Maybe we'll talk about that some other time. That is just amazing, and has never been really called to task over that. Just amazing. So accounting is not always so pristine, even at the policy setting level, is it? These give you some flavor of what goes on and the kind of methods that are used. And again, go and look at some of the materials that I sent, because there's many more specific examples of how this actually gets accomplished. But you can see now with these illustrations how the accounting transaction entries actually would work and how they fix things in terms of managing earnings. But the other thing I want to finish with here is to go back and talk for a minute just about why managers would want to manage earnings up or down. I've already said that they do, and I gave you an example in the first video about the whole compensation thing, and if there's a bonus related to the earnings of the company, of course, you can see how managers would want to use the accounting methods which show higher earnings. So what would be examples of incentives to manage earnings up? So we could have the general incentive, right, which is meet the forecast. Or we talked about that. So we don't want to disappoint the analysts, so we'll manage earnings up. That's a big deal. Or there could be some sort of a compensation or bonus related calculation whereby our compensation or the bonus of the CEO or the management team, whatever, is based upon some calculation involving earnings or earnings per share or something involving accounting numbers, right? Now here's another one we haven't talked about. There could be usually they're loan or debt contractual issues. That's loan/debt. That's kind of hard to see, I know. So remember, if a company has loans or debt outstanding, usually there's debt covenants or loan agreements and so forth, and those typically have some financial accounting requirements in them related to ratios or profitabilities or other financial performance or condition measures, and the company has to maintain those with respect to its actual accounting, how things turn out. So you can imagine a company, for example, that would be very close on some kind of a return metric might want to use accounting earnings management to increase their return numerators so that they don't violate the debt covenants. What happens is if you are in violation of these things, you can go into what's called technical default. It doesn't mean the company's going to go bankrupt, but what it means is they're going to have to go back and renegotiate the loan. And guess what? If you are in that kind of situation, you're going to be paying higher interest rates when you do that. I mean, of course, if things are really bad, you may end up with the debt holders going and trying to force a bankruptcy, but more commonly, it involves a renegotiation, a recontracting around that liability and that debt, and it's expensive. And so we may do things to avoid this as well. All right? And then there's these compensation bonus. There's also the whole stock option thing, right? Now, let me remind you how stock options work. Typically, a stock option is the option for a manager to buy stock at a certain price. Usually, at the date the option is granted, the option price is actually higher than the current market price. Not always, sometimes it's the same. But for tax reasons, it's always usually at least equal to the current market price or higher. So you might think, well, what the heck is the value of that? If the market price of the stock is here, right? And we're giving some manager the right to buy the option, or an option to buy the stock at this price here, you know, and it's higher than the current market price, what is the value of that? Well, as an incentive, the idea is to motivate the manager to undertake their management so as to increase the value of the company. So they would want to increase the value of the company so that the price goes up like this. So at some point in the future, the price will be here. And the manager still has the option to buy here. So they would never buy it. If the price never gets to that, those options are called underwater, right? Who's going to exercise that? They're just allowed to expire. Sometimes they get repriced by the companies. But you're not going to be exercising. The managers don't exercise them if they're below the option price is above whatever the market price is. So it's only when the price goes above. And so assuming that it does, then we're allowed to go ahead and pay this price for the stock, and then we can turn around and sell it at this price. So we've got a gain there. So that's how stock options work. So you can see from this, right, that, well, there's an incentive for managers when they get out to here to want to engage in earnings management when they're ready to exercise their options and turn around and sell the stock perhaps. They have incentives to want to make the earnings of the company look good, and of course, since investors are really buying the future, to make it look also so that the company will continue to have high earnings. So that will boost up the price of the stock. So that is related to the stock option issue here, right? See that? But we're going to go over to this other side now. It's also possible that we got to think about what's going on here. So what happens if the manager knows he's going to be granted options? So it's possible at the point of option granting that the manager wants to manage the earnings down and make them look worse. See that, right? I mean, because they would like the option price to be here. Where would you rather have the option price? At point 1 or point 2? Well, point 1, sure, right? And so if you can make the company's earnings not look so good for a little while, when you know that options are going to be granted to you, then you have essentially much larger potential future gains because you'll get this, right, instead of this when that future comes along. So even at the point when options are granted, there's an incentive for managers to manage earnings down. There's also, I talked about that big bath. There's another one. And this happens a lot of times when you get new management. Not always. But basically the idea is when you have a big bath, you write off everything that you can. Why? Well, what you're really doing is you're managing earnings down, and so you're writing off everything you possibly can, setting up as many reserves and allowances you possibly can get away with. So what does that mean? Well, that means that the future is going to look pretty good, isn't it? Because if you've gotten all the potential losses out of the system, what can there be in the future but revenues and profits, right? So I mean, a company that is engaging in a big bath says, where things are bad, we might as well get it all out now and basically set the stage to look good in the future. So these are two examples of powerful incentives for managers to want to manage earnings down, not always up. I guess the last thing I want to mention is that this whole idea of moving from earnings management into fraud. And you do have cases where companies just are completely fraudulent. You know, they really just invent revenues from out of thin air. Or there's the so-called Ponzi schemes where you're taking money from some people and then you pay them back more than they paid in, and that induces other people to make investments. The Bernie Madoff is the perfect example of that. But the idea there is you have to have, it has to look like this. The investment base looks like this, because you take the money from these guys, right? You have to have, and so you get the second tier. You take the second tier money to pay off the first guys, and the third to pay off the second. Of course, paying yourself as well as you go. And eventually this doesn't break down, right? Go look up equity funding scandal. That's a great example. Equity funding. That's a great example of this. So these are just out and out frauds. But most of the time, that's not the way these things go. Most of these are companies that are really legitimate companies. Global Crossing, WorldCom, Waste Management, Enron, AOL, even GE. I mean, almost, I'm trying to think of, there's actually more companies that have gotten involved or entangled in earnings management than haven't. I'm not saying they're all to the level of fraud, but clearly earnings management that require them to go back and change their financial reports, doing what we call a restatement. Restatements are an indication that something went wrong. It could have been innocent, but a lot of times it's earnings management that went too far. So these issues of fraud, the point is this. A lot of accounting managers, a lot of attorneys, advising managers, they get involved in these situations in which earnings management is seen as a relatively innocuous, pedestrian, and it's not evildoers. We're not talking about evildoers here that are trying to do wicked things. They're just dealing with the uncertainties of markets. They can rationalize to themselves the need to manage earnings a little bit because things are kind of crazy. But it gets to a point where you have to be careful because it's a slippery slope. If you look at these companies, like WorldCom is a great example of this, where as things went south, as things got bad, they got to the point where they had to make a decision where they were going to cross the line from earnings management into clearly improper accounting, fraudulent accounting. And they were in so deep at that point. And even at that point, just from the earnings management, the implications were so awful that they decided just to go ahead. And this is the danger. This is the thing you got to watch out for. So it's not that people go in and intend to defraud people. They get into it a little step at a time. It's a slippery slope, and they get in these bust periods or these problem periods, and that's what you have to be really careful about, because you don't want to be saying goodbye in handcuffs, guys. Okay, I think that covers it for today, and I thank you for spending some time looking at these videos.